In our strategy, we run a 5-phase cycle framework. We don't predict headlines, we track signals, pressure, and sequence. The objective is durability, survive volatility, preserve optionality, deploy with confirmation. Gold and silver are at all-time highs, and the instinct is binary. Either you've missed it, or you're about to buy the top. But that framing misses what actually matters. We're reviewing a video arguing that metals are being driven by institutions, not retail. The claim is that this is a structural money shift, not a speculative spike. Our job is to translate that into our strategy. The video claims central banks are accumulating gold aggressively. It claims regulatory treatment has shifted incentives toward physical gold. And it claims alternative settlement systems are reducing marginal dollar dependence. In our strategy terms, that's policy credibility and reserve diversification. These are slow, powerful forces, not timing tools. They shape trend risk, not day-to-day price action. Institutions don't buy gold for momentum. They buy it to reduce counterparty and regime risk. That distinction matters for how we position. The video argues futures leverage and margin mechanics distort price discovery. Whether you agree fully or not, leverage always amplifies swings. That means drawdowns can occur even in bullish backdrops. So our strategy avoids single entry decisions at highs. We prefer tranches, confirmation, and patience. This is how you stay solvent through volatility. Gold acts more like a reserve hedge. Silver is a hybrid, monetary plus industrial, and much higher beta. So we manage them differently. The video claims solar, EVs, and AI hardware are tightening silver supply. If true, that's a structural tailwind. But higher beta also means deeper corrections. This environment fits Phase 1, trend up, fragile correlations. The risk is a transition toward Phase 2 if liquidity tightens. That's when correlations spike and everything sells, temporarily. In our strategy, metals can drop first in a funding squeeze, not because the thesis failed, but because liquidity evaporates. Recovery depends on policy response and stress containment. We watch real rates and the dollar's funding pulse. We watch credit spreads and market breadth. These tell us when pressure is rising. Contained funding markets, stable or falling real yields, metals holding up better than risk assets during drawdowns. Widening credit spreads, breadth deterioration, persistent USD funding stress. Gold stays an anchor hedge, sized as insurance. Silver is treated as higher beta with wider risk bands. Cash remains optionality, not a mistake. Quick note before we wrap, this is educational macro commentary, not financial advice. We're discussing signals and frameworks, not telling you what to buy or sell. We upgrade the importance of reserve diversification signals. We stay cautious on leverage and single-entry behavior. And we respect the paper versus physical volatility channel. We still wait for confirmation. We still expect drawdowns even in bullish regimes. And we still prioritize survival over prediction. This may be an early-stage regime shift or a powerful trend with traps. Our strategy doesn't need to be first. It just can't afford to be reckless.